Did you know in a single year, a seemingly stable blue-chip stock can see its value plummet by half? It is a startling reality many investors face. Companies aren't immune. A global corporation can see millions in projected revenue evaporate in a single week from an unforeseen currency swing. These are not rare black swan events, but recurring patterns across global markets. Markets are inherently volatile, driven by economic data, geopolitical events, human sentiment. This isn't meant to induce panic, but to create respect for forces that affect your financial well-being. This ceaseless ebb and flow of value is why hedging matters. Ignoring volatility is like a sailor heading into the ocean without a weather check. Calm sailing can be followed by a sudden storm. Defense is as important as offense. That recognition opens the door to protective strategies. At its heart, hedging is a strategic action taken to reduce the risk of adverse price movements in an asset. Think of it as purchasing an insurance policy for your investments. Think of it as purchasing an insurance policy for your business revenue. When you buy home insurance, you're not hoping your house burns down so you can collect the payout. Instead, you're paying a small, known cost, the premium, to protect yourself from a large, uncertain, and potentially catastrophic loss. Hedging operates on the very same principle. It is not a tool designed to generate profit. Its primary purpose is defensive, to safeguard value. Its primary purpose is defensive, to minimize the impact of significant losses. Its primary purpose is defensive, to bring a measure of predictability to an otherwise uncertain future. The necessity for hedging arises directly from the unpredictable nature of our global economy. A farmer planting seeds in the spring has no way of knowing what the market price for wheat will be at harvest time in the fall. An international exporter selling goods in Europe does not know what the euro to dollar exchange rate will be when payment is received in 3 months. An investor holding a diversified portfolio still worries about the possibility of a broad market downturn that could erode their retirement savings. Embarking on a hedging strategy can seem complex, but it can be broken down into a logical, 4-step process that brings clarity to the endeavor. The very first and most critical step is to identify the specific risk you need to manage. You must ask yourself, what external factor poses the greatest threat to the value of my asset or my expected cash flow? For a corn farmer, the primary risk is a drop in the price of corn. For a multinational that manufactures in one country and sells in another, the risk is an adverse currency move. For a stock market investor, it may be a broad market decline. Pinpointing the exact nature of your exposure is the foundation. Once the risk is defined, choose the appropriate hedging instrument or tool. A futures contract is a standardized agreement to buy or sell an asset at a predetermined price on a specific future date. An option gives the holder the right, but not the obligation, to trade an asset at a set price. A forward is a private, customized agreement between two parties. Swaps involve exchanging cash flows. Each tool has unique characteristics, costs, and benefits. Pick what matches the risk. The third step is to correctly size the hedge. You don't have to hedge everything. A partial hedge balances cost and safety. To bring hedging into the practical, let's consider a wheat farmer. She expects to harvest 5,000 bushels in 3 months. She worries the price will fall because of a bumper crop nationwide. She sells futures today at $7 per bushel to lock in price. Now, one of two things will happen. If the market falls to 6, she loses $1 per bushel on the crop, but the futures gain $1, perfectly offsetting the loss. If a drought pushes price to 8, she forgoes the extra dollar because of her futures position. Her effective selling price remains $7. She traded uncertainty for certainty and can plan, borrow, and invest with confidence. An investor owns a tech stock at $150 and fears a correction. She buys $140 puts expiring in 3 months, paying a small premium. If price drops to $110, her losses are capped. She can sell at $140. If price rises to $170, the option expires worthless. Only the premium is lost.